What actually happens to wealth when the world panics? You know, it's a question that literally defines the line between those who are ruined by economic disasters and those who emerge from them vastly more wealthy. When the stock market plummets and the headlines are screaming about a global financial meltdown, our deepest human instinct tells us to flee, to sell everything, to run for cover. But if you look closely at the data, you'll see a very, very different reality unfolding behind the scenes.
Just look at this number for a second. 82.69. That isn't just some random statistic. That was the daily peak of the VIX, which you might know as the stock market's fear index, on March 16, 2020. Now the VIX normally hovers right around 20. So a spike past 80? That captures the visceral, absolute terror of a global market in total freefall. It was a moment of completely unprecedented uncertainty. But here's the crazy part. While the masses were paralyzed by that fear, a very specific class of investors was quietly going on the offensive.
Welcome to this explainer. Today, we're diving into the unseen playbook of strategic asset acquisition during market crashes. We're going to look at the official data from the Federal Reserve, the SEC, and historical market records to understand exactly how the ultra-wealthy approach economic disasters entirely differently than the average person. And more importantly, how they use these terrifying moments to preserve and even compound their wealth. So to understand this playbook, we first need to understand the environment where it's executed.
Section 1. The anatomy of panic and the divergence of capital during market crisis. Let's get right into it.
Okay, let's trace the timeline of the 2020 COVID-19 crash. This event was an unexpected, massive outside shock to the system, and it was completely unique in its sheer velocity. On February 19th, the S&P 500 hit a peak. Just 26 days later, on March 16th, that fear index we talked about hit 82.69. And by day 33, March 23rd, the S&P 500 had bottomed out at a staggering negative 34%. It was literally the fastest transition into a bear market in history. Panic sets in incredibly fast during these shocks, and honestly, it blinds most people to the reality of what's actually happening to asset prices.
And right here is where we see a fascinating behavioral split. Research into high-frequency data shows a really stark contrast. On one side, you have the retail investor reaction. Everyday households dealing with spiraling debts and falling prices. Maybe they're heavily leveraged, they're panic selling, and their Google searches for market information are peaking way too late. But on the other side, institutional and wealthy investors show abnormal searching on their Bloomberg terminals on the exact day of the market shock. They aren't panicking at all. They are actively using their data advantages and insider knowledge to accumulate high-quality assets that have just been severely mispriced.
Section 2. The Wealthy Investor Playbook. Capitalizing on cyclical dislocations.
So, if the instinct to run away is wrong, what's the right move? Let's look at the specific strategies used to preserve and compound wealth when everyone else is selling. The crucial point here is perfectly summarized by the foundational principles of Warren Buffett. He views market fear not as a threat, but as a transactional advantage. His crisis investing basically boils down to 3 steps. First, the rule of understanding. Completely avoid complex products you just don't grasp. That rule famously kept him out of the dot-com bubble crash. Second, opportunity in crisis. Recognizing that widespread panic creates the mispricing necessary to acquire high-yielding assets on the cheap. And third, investing versus speculating. You're buying fundamentally profitable businesses that will deliver recurring income over a century rather than just betting on some short-term price target.
Now, this completely flips a common piece of financial advice right on its head. We always hear the phrase cash is king during a crash, but in his 2008 shareholder letter, Buffett clarified that cash is only king when it's actively being deployed to purchase undervalued assets. Clinging to cash or low-yield treasuries long-term just out of fear is actually a terrible policy because your purchasing power is eventually going to be silently eroded by inflation. The wealthy don't hoard cash, they use it as ammunition.
That brings us to Section 3, the Fed's shock absorber, the structural backstop for unconstrained capital. But to deploy that capital safely, these investors rely on a really critical foundation. This is kind of the climax of our economic narrative here. During a period of deep financial instability, private intermediaries just freeze up. Nobody wants to lend. That's when the Federal Reserve steps in to essentially stop the bleeding. They act as the liquidity provider of last resort. Back in March 2020, there was such a massive dash for cash that even the safest assets on Earth, U.S. Treasuries, were being fire-sold. By using open market operations to stabilize the Treasury market, the Fed injects necessary liquidity. And what that does is effectively signal to unconstrained wealthy investors that the system isn't going to collapse and it's completely safe to step in and buy assets at rock-bottom prices.
And this data here brilliantly illustrates the broader societal outcome of those interventions. Notice how the Gini coefficient, which is a measure of wealth inequality, shifts during these periods.
The data clearly indicates that while these Federal Reserve monetary policy shifts and liquidity injections are absolutely vital for stabilizing the broader economy during a crash, they can structurally increase wealth inequality over the medium term. Why? Because those who actually have the unconstrained capital to buy the dip, well, they see their wealth compound dramatically as the market recovers.
Section 4. The math of recoveries, visualizing post-crisis returns.
Let's look at the hard historical math of what happens after the panic finally subsides. When you look at the S&P 500 index cumulative returns following the end of major bear markets, from the Great Depression to Black Monday in '87 to the global financial crisis, an incredible picture emerges. Look at those teal bars representing 10-year returns. They are massive. It proves historically that sharp, sudden, terrifying market declines are consistently followed by robust, long-term gains. Think about it. If you sell at the bottom, you lock in the loss and completely miss the recovery.
This builds a really compelling case for patience. Imagine if you made a hypothetical $100,000 investment at the absolute worst possible time, literally at the end of the 10 worst calendar years since 1975. What happened next? Well, 1 year later, you were up 80% of the time. But look at the 5 and 10-year marks. Historically, returns have been positive 100% of the time. 10 years out from the absolute worst crashes, that initial 100 grand averaged over $315,000. Time in the market heals the wounds of trying to time the market.
Section 5. Strategies for managing risk, execution, and portfolio construction. Let's see how this is actually done.
So how do you actually execute this without losing your nerve? The good news is, you don't have to be a billionaire to use the mechanics of this playbook. It all starts with a concept you might already be using in your retirement account: dollar cost averaging, or DCA. This is a strategy where you invest a fixed dollar amount at regular intervals, completely ignoring the market's direction. It is the ultimate psychological tool to mitigate market timing risk. You know, that fear of dumping a lump sum into the market right before it falls. It takes fear and greed out of the equation entirely.
Let's run the numbers. If you commit to investing $1,000 a month during a market crash, watch what happens. In January, at $20 a share, you buy 50 shares. But as the market crashes down to $10 in March, that exact same $1,000 automatically buys you 100 shares. Without even thinking about it, DCA naturally forces you to act like a wealthy institutional investor. You are accumulating way more assets precisely when they are historically cheap. Your average cost per share drops, setting you up perfectly for a massive rebound.
Now, high net worth investors take this a step further through diversification via private markets. They don't just buy public stocks. They allocate a portion of their capital to illiquid assets, things like commercial real estate and private operating companies. Why do they do that? Because these assets offer contractual cash flows like rent and provide tangible downside protection. They don't swing wildly in price minute by minute on a public ticker, which drastically reduces overall portfolio volatility and provides you with inflation-sensitive income while the public markets are out there panicking.
Ultimately, the architecture of accumulating wealth during a crisis is deeply psychological. It requires serious counter-cyclical discipline. As Warren Buffett noted, approval, though, is not the goal of investing. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. When the world is panicking, the wealthy are quietly executing a well-structured plan. They aren't looking for applause, they're looking for value. So as you look at your own financial strategies, ask yourself, when the next inevitable market shock arrives, will you be following the panicked crowd or the unseen playbook of the wealthy?